We actually use the volatility to our advantage. We are what is called a liquidity provider. So when our stocks get hit hard, or stocks that we're interested in get hit hard, and our research is pointing toward them as primary beneficiaries of the way the world's going to transform, we will buy.
Cathie emphasizes the importance of 5 key innovation platforms: robotics, energy storage, artificial intelligence, AI, blockchain technology, and multi-omic sequencing in life sciences. She believes these platforms will converge, breaking traditional industry boundaries and transforming the world. For this reason, ARK's research team is organized around technologies rather than sectors, as they foresee a future where sectors will blur due to technological advancements. Cathie underscores that many investors and analysts still underestimate the potential of these innovations. This mispricing creates opportunities for ARK, which freely shares its research to help people understand how profoundly the world is changing.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
In the last 6 months, it has reached an extreme that we've never seen before. And so it's unlikely to continue to concentrate into just a few stocks. And the broadening out process should be great for our strategy, which is the closest you'll find to a venture capital firm in the public equity markets. We're really trying to find those companies and stocks that are going to populate the indexes in the future. We're just trying to find them early. And we give our research away because we think this part of the market is so inefficiently priced. And we want people to understand how provocatively the world is changing, how 5 innovation platforms, so robotics, energy storage, artificial intelligence, blockchain technology, and multi-omic sequencing in the life science space are going to transform the world completely, because these platforms are converging. And we've set up our research team to follow technologies, not sectors, because we think that's the way the world's going to evolve. The lines between and among sectors are going to blur because of technology. So we think the opportunities are immense, and we want to provide a differentiated exposure to innovation. We actually use the volatility to our advantage. We are what is called a liquidity provider. So when our stocks get hit hard, or stocks that we're interested in get hit hard, and our research is pointing toward them as primary beneficiaries of the way the world's going to transform, we will buy. And when, on the other hand, the market gets really excited about some of our stocks, we will sell, even though. And what I mean by that, this is just trimming around the edges. I'll give you an example. Tesla is our largest position, and as a firm, and we have, when it got down to 100, 150 in the last couple of years, we were buying aggressively. As it has scaled up to roughly 250, we'll take some profits. Now, why do we do that? We do it because disruptive innovation is controversial. And so we know the stocks are going to be volatile. And over the years, we've been able to add to our performance by trimming when stocks are really scaling at a very rapid rate, and by buying when they are falling. So, buy low, sell high. But we really do that just at the margin, because we are a high conviction manager. So you're not going to see us flipping in and out of stocks. We have right now um, a portfolio that has been fairly concentrated. And so our conviction is very high as we wait for lower interest rates and a broadening out of the market to take our highest conviction names higher.
Cathie shifts the conversation to economic indicators, identifying a mixed bag of strong and weak data. On the positive side, she notes robust productivity growth of around 2.5 to 3% and wage increases averaging 4%. This suggests that corporations are sharing wealth with employees, which aligns with ARK's belief that innovation and productivity will drive sustainable economic growth. However, Cathie also highlights areas of concern, such as weak non-farm payrolls, temporary employment, and ISM service reports, which suggest underlying fragility in the labor market. While unemployment remained lower than expected at 4.1%, other metrics, such as temporary help employment and manufacturing activity, paint a less optimistic picture.
You know, the indicators that were strong were healthcare, education, government primarily. If you looked at cyclical indicators, exceedingly weak, still exceedingly weak. So that's non-farm payroll. The unemployment rate, so the headline number, actually ticked down from 4.2% to 4.1%. Many thought it would tick up. It did not. And then the average hourly earnings were a bit stronger as well, 0.4% month to month. Expectation was 0.3. So average hourly earnings are going up 4% on average per year. Now, productivity, it seems, is in the 2.5% to 3% range. So what that means is if average hourly earnings are at 4% and productivity 2.5% to 3%, then the underlying inflation rate is in the 1% to 2% range, probably. So that's good. It's good that wages are going up as productivity goes up. Corporations are sharing some of the wealth. On the negative side of the unemployment rate, the manufacturing was down, temporary help was down. Temporary help's a leading indicator, but it's been coming down for a very long time, so it hasn't been much of a leading indicator. Hours worked were down about 0.3%. So that takes away from some of the very positive statistics. And if you looked at the ISM service report this week, employment in that report was surprisingly weak, just like in the manufacturing part of that report. So again, conflicting indicators. In terms of the week-to-week initial claims, those have surprised on the low side of expectations. This week, JOLTS, so job openings, those surprised on the high side of expectations after coming down fairly dramatically. So that was interesting. And I guess the only other variable on the labor side was the Challenger layoff survey. That shot up 53% on a year-over-year basis. So we know there are layoffs. We read them in the newspapers, and they are up 53% on a year-over-year basis. So in terms of, I'm now going to separate just in the last month, just the balancing act that's going on here in the world of economic statistics. So household net worth, the change in net worth, that was up very strongly. The stock market has been up. Home prices have been up. Those are the two biggest indicators. Now, if you look at both of those in the stock market, market concentrated towards very few names, that's not a great indicator. We prefer to have it broadening out. And in the housing market, while pricing is up, the actual units sold, units started, have collapsed and have not come back. In fact, I look at some of these indicators and, I started in the business when I was in college in the late 70s. And some of these housing indicators, the home sales, existing home sales, new home sales, they are lower now than they were when I started in the business. That's crazy. The population is so much larger. It's quite shocking. The number of people trapped in their homes by very low interest rates, they can't move because if they do and take on another mortgage, their mortgage rates will go up twofold or threefold, maybe even fourfold. And so that's definitely lowered the velocity of housing. And that's not so great. Also positive, I mentioned University of Michigan survey. Here you can see it ticked up. Again, I think inflation coming down is very important there. We saw retail sales in the month of August, reported in September. They were up very slightly, in fact, probably down in real terms, but they did not fall back much after a very strong reading, the 1.1% the previous month. So we have to put that in the strong camp. Mortgage applications in the housing realm have been moving up quite nicely. So that's a positive for housing. Industrial production was up strongly in this last month. And that's after a significant decline. But the revisions there are now starting on the upside. And then finally, the ISM for the service sector, that was much stronger than expected. Okay, so those are the strong. Now, on the weak side, leading indicators are still falling. They've been falling for, I think, 2 years. Leading indicators, when I started in the business, if they were down 3 months in a row, then the probability of recession was very high. So there is something in the underlying economy that is not well for the leading indicators to continue down. If we look at the personal income and saving, we saw something that, again, I was shocked to see this, the revision so significant that the saving rate went from 2.9%. That's where we thought it was the last time we showed you charts. It's now 5%. I think we have this on the next chart. So it's now 5%. Now we were operating under the assumption that the saving rate was very low, and it's low by historical standards, but it's not as low as we thought it was. And one of the reasons is transfer payments. So government subsidies have been much higher than expected, and dividends. Those were the two primary indicators to revise the saving rate up.
Cathie concludes by addressing the delicate balancing act between inflation and economic growth. She believes that inflation is moderating, with underlying inflation likely in the 1 to 2% range thanks to productivity gains. However, leading economic indicators continue to fall, which Cathie finds troubling. Historically, a decline in leading indicators for several months has been a strong predictor of a recession. Cathie remains optimistic that lower interest rates and a broadening market will eventually boost ARK's highest conviction investments. She reiterates ARK's focus on disruptive innovation, confident that these investments will lead the next wave of economic growth. For Cathie, market volatility is not a threat but a tool, one that allows ARK to capitalize on mispriced opportunities and maintain a long-term focus on innovation.
Please like and subscribe my channel.